Many Australians focus on how much super they've saved, but that's only part of the picture. Have you ever thought about how tax can impact your retirement? Without a plan, tax can quietly chip away at your retirement savings, giving you a less than ideal retirement. The good news? You don't need risky investments or complicated loopholes to fix it. In fact, a few simple tax strategies used at the right time can make a huge difference. In this video, I'll walk you through 9 smart, completely legal ways to reduce your tax, so you can grow your super faster in the lead up to retirement. Hey, I'm Chris Strano, founder of SuperGuy.com.au and managing partner at Toro Wealth, where our vision is to be Australia's most trusted retirement planning firm. If you haven't already, make sure you grab a copy of my 6-step Super Check for Retirement. You'll find the link in the description below. And just a reminder, this video is general information only, not personal advice. Alright, let's start with one of the simplest and most tax-effective strategies. Number 1, salary sacrificing into super. So, salary sacrifice means asking your employer to redirect part of your income straight into super before it's taxed, instead of paying it to you as a salary. These contributions are taxed at just 15% or 30% for higher income earners, rather than your marginal tax rate, which for most people is much higher. Because the money comes out before tax, your taxable income drops. And that means you're paying less tax today and growing your super faster at the same time. Here's a simple example. Let's say that you earn $100,000 and decide to salary sacrifice $10,000. Your taxable income drops to $90,000, so you pay less tax straight away. Inside super, that $10,000 is taxed at just 15%, which is lower than your personal tax rate. In this type of scenario, the net tax savings is $1,700, and that's real money that you'd otherwise never see again. And that saving is before you even factor in the long-term investment growth inside super, where all earnings are taxed at the lower rate of only 15%. It's worth remembering that salary sacrifice contributions count toward your concessional contribution cap, which is $30,000 for the 2025-26 financial year. And if salary sacrifice isn't available to you, or you want more flexibility, there's another way to get the same benefit, which brings us to our next strategy, number 2, personal deductible contributions. If you haven't reached your concessional contributions cap through salary sacrifice or employer contributions, you can still make the most of it with personal deductible contributions. This simply means contributing money from your own savings into super and then claiming a tax deduction for it. The result is identical to salary sacrifice. You reduce your tax on your income because your contributions are taxed at only 15%, and you grow your super faster inside super where the tax on earnings are lower. And like salary sacrifice, these contributions count towards your $30,000 concessional cap. Now, if you've already hit the concessional cap and you still want to put more into super, that's where the next strategy comes in. Number 3, the carry forward rule. If your total super balance was under $500,000 on 30 June from the previous financial year, the carry forward rule lets you use any unused concessional caps from the past 5 years, allowing you to contribute more in a single year and potentially claim a larger tax deduction. Do you know if you've got any unused concessional caps built up from previous years? Here's how this might work in practice. Let's say that you never fully used your concessional caps and you sell an investment property for more than you purchased it for. Because your total super balance is under $500,000, you may be able to use those unused caps to make a large one-off contribution to super and claim a much bigger tax deduction than normal. This can significantly reduce capital gains tax while also giving your retirement savings a serious boost. Just be aware that eligibility for the carry forward rule depends on your personal situation. Plus, super rules can always change, so it's worth getting advice before making large contributions. Once you've optimized your concessional contribution caps, there's still another way to keep building super in a tax-effective way, using non-concessional contributions and the bring forward rule. Non-concessional contributions are a great way to move larger amounts of already taxed money into super, such as bank savings, an inheritance, or even the proceeds from the sale of a property or shares. Even though this is after-tax money, the benefit comes from what happens next. Once the money is inside super, any future investment earnings are taxed at a maximum of 15% instead of your personal tax rate, which again is often much higher. This tax then reduces to 0% once you retire and start an income stream. And over time, that lower tax rate can make a meaningful difference to how much your balance grows compared to keeping it outside super. The total cap for non-concessional contributions is $120,000 in the 2025-26 financial year. Now, if you're under age 75 and your total super balance was less than $2 million at the previous 30 June, you may be able to use what's called the bring forward rule. This allows you to bring forward up to an additional 2 years worth of the non-concessional caps So in simple terms, you could contribute $360,000 in one go and then nothing for the following 2 financial years. And to get even more into super, here's a powerful timing tip. You could contribute $120,000 in, say, May or June using the current year's cap. Then after 1 July, you could contribute up to $360,000 using the bring forward rule in the new financial year, because the bring forward rule is only triggered in the financial year that you exceed the general cap. So that's potentially up to $480,000 added to super in a relatively short window of time. That's not an everyday strategy, but if you've sold something valuable, it can be incredibly effective. Again, I'd suggest getting personal advice before making large contributions to super. But non-concessional contributions aren't the only option. If you're looking to move even more into super, strategy number 5 is worth a look: the Downsizer Contribution. For many Australians, a large part of their wealth is tied up in the family home. And a lot of clients tell us the same thing. There's fewer kids at home and more rooms storing their stuff. Now, while downsizing isn't for everyone, selling your home can also unlock a very powerful tax strategy. If you're 55 or older and have owned your home for more than 10 years, the Downsizer Contribution lets you put up to $300,000 from the sale of your home into super. What makes this different is that it sits outside the usual contribution caps. Even if you've already maxed out your concessional and non-concessional limits, this contribution can still be made. For couples, that's up to $600,000 combined. By moving some of your home's value into super's low tax environment, you can reduce the tax you pay on future investment income and strengthen your retirement position at the same time. Now, of course, downsizing is also a lifestyle and sentimental decision. But if you are already planning to sell or downsize in the lead up to retirement, this is a rule worth knowing about. And if you're a business owner or planning to sell business assets, there's another tax strategy many people miss. That is number 6, capital gains tax and the CGT retirement exemption. If you own a business or are planning to sell business assets, this next strategy is really important to understand. There's a specific capital gains tax concession called the CGT retirement exemption, and for the right person, it can save hundreds of thousands of dollars in tax. If you sell a business or certain business assets, you may be able to move up to $500,000 into super without paying capital gains tax, even if you've already used up your normal contribution caps. You've paid enough tax over the years. This one time, the rules finally swing back in your way. Not only do you avoid paying CGT, but you also put more of your wealth into super where future earnings are generally taxed at only 15%. For business owners nearing retirement, this can be one of the most powerful and most overlooked tax strategies available. Now let's shift gears and look at a strategy that applies if you're still working, but starting to think about winding down. Strategy 7, transition to retirement pension. If you're still working in age 60 or over, a transition to retirement pension or TTR can be a very effective tax strategy in your final working years. A TTR pension allows you to start drawing an income from your super while you're still working. It's designed as a bridge between full-time work and full retirement, giving you more flexibility without needing to stop work. What we like to implement with our clients is to use a TTR pension alongside salary sacrificing. So what you do is you redirect more of your salary into super as pre-tax contributions, which are taxed at just 15%, less than your marginal tax rate. And then to keep your take-home pay the same, you use tax-free TTR pension payments to top up your income. Same income, less tax. As a result, you keep your take-home pay the same, reduce your working hours if you choose to, and continue to build up your super and reduce the tax you pay. It sounds complicated when you first hear it, so I've done a full video on this exact strategy, and the link is in the description. For the right person, a TTR pension can be a really practical way to make your last working years more tax efficient. But like any strategy, it needs to be set up properly to work as intended. Once you do fully retire, there's another step that can make a huge difference in how much tax you pay on your super going forward. Number 8, account-based pension. Once you're 60 and retired, one of the most important steps is converting your super into an account-based pension. An account-based pension allows you to draw a regular income from your super while still keeping your balance invested. For most people, it makes sense to move as much of your super as possible into an account-based pension up to the $2 million transfer balance cap for the 2025-26 year to take advantage of the tax benefits. And here's where the big tax benefit comes in. When your super is in an account-based pension, the investment earnings are tax-free. And from age 60, the income payments you receive are usually tax-free as well. Compare that to super still sitting in your regular accumulation account where investment earnings are taxed at up to 15%. That difference alone can have a major impact on how long your retirement savings last. Exactly how much you move into an account-based pension and when depends on your situation, so it's worth thinking through carefully or getting advice before you decide. This final strategy is one many Australians don't realise even exists, and it's all about what happens to your super after you're gone. Number 9, the recontribution strategy. Super can sometimes be taxed when it's passed on, especially if it goes to adult children. In those cases, the taxable portion of your super can be taxed at up to 17%, which means your beneficiaries could lose $17,000 for every $100,000 they inherit. And most people don't mind paying tax, but they really hate paying tax unnecessarily, especially when it comes out of their kids' inheritance. That's where something called a recontribution strategy can help. This involves withdrawing money from super and then recontributing it as a non-concessional or after-tax contribution. Doing this converts money from the taxable component into the tax-free component. The more of your super that sits in the tax-free component, the less tax your beneficiaries may pay in the future. I know this sounds confusing, so let's cut to the benefit. In simple terms, it helps more of your retirement savings go to your family rather than the ATO. I know where I'd rather my money go. So when you step back and look at all of these strategies together, which one made you think, I really should look into that? Look, paying less tax in retirement isn't about loopholes or clever tricks to dodge the ATO. It's about understanding the rules and using them to your advantage. Your final working years are actually one of the most powerful times to make these decisions count, because the structure you put in place now can shape your income for decades. Plus, you'll have access to any amount contributed soon enough. If you'd like clarity on which of these strategies makes sense for you, that's where we can help. At Toro Wealth, we work with Australians aged 55 and over to help them optimise their financial position in the lead up to retirement. Head over to torowealth.com.au to learn more. If you found this helpful and you want to make smarter retirement decisions, make sure you're subscribed, and I'll see you on the next video.